stock market action, the main share index declined for a third straight session on the back of this BSP rate rise move, and the U.S. reporting higher than expected inflation of 9.1%. Most of the indices closed in the red, with property the biggest loser. Today's top decliners were Ayala Land, SM, and Universal Robina. So how will the Bangko Sentral's aggressive move affect businesses and consumers? We're joined now by Eugenia Victorino, Head of Asia Strategy at Swedish Bank SEB. She joins us now from Singapore. Eugenia, thank you so much for joining us. We heard your fellow analysts talk about this aggressive rate rise by the Bangko Sentral ng Pilipinas. So in your view, will this 3/4 of 1% rate hike today bring down inflation and tame rising prices?
I would say that this is just the beginning. Clearly, with inflation at 6.1%, at least as of June, it is not enough that we have only, or the BSP has only raised the policy rate by 1.25% since the start of the year. At this point, it is very important for the Bangko Sentral ng Pilipinas to regain the narrative, at least as far as inflation expectations is concerned. Inflation forecasts are definitely rising, not only for 2022, but also for 2023. Already, inflation forecasts for 2023 are already above 4%, which is still above the central bank's target range. So they need to do more above this.
So when you say they need to do more, how many more rate rises are you expecting from the BSP this year, from the current rate of 3.25%?
Well, I definitely expect another 50 basis point hike in August and possibly 25 basis points for every meeting thereafter, raising the policy rate to 4.5% by the end of this year. At the end of the day, 4.5% policy rate is not that high. It's possibly a little bit tighter than historical averages, but it's not enough to really strangle the growth. So at the end, we really need to take control of the inflation, and higher interest rates is the key to that.
All right, from now until the next meeting, which is on August 18, there may not likely be another move at 3.25%. Can this bring down inflation? When will Filipino consumers start to experience lower prices?
It is quite likely that inflation would already start to ease in Q4. But that doesn't mean that the price levels are going to go down. There is a hope that energy prices, which have already been starting to go down, would continue to ease. But at the end, the energy crisis in Europe will keep the energy market very tight. And even if the oil prices go down, it's unlikely to go down to $60 per barrel from here.
And with this rate rise, we only saw the slight appreciation of the Philippine peso, just appreciate between maybe 10 to 12 centavos today. Why did it appreciate that much? And where are we likely to see it in the near to medium term, Eugenia?
Well, there are different factors that are affecting the dollar-peso exchange rate. First of all, even if you increase the interest rate by 75 basis points or 3/4% today, that is still not enough to widen the interest rate differential between the U.S. Second, the trade deficit in the Philippines is just likely to continue to widen from here. That would mean the general flow, or the real flow of dollars into the economy, would still be in deficit. Third, the global risk sentiment is just not very forgiving for currencies like the peso. So at the end, by the start of the European session this afternoon, the dollar dominance was back, and dollar peso was above 56 once again. I would expect dollar peso to reach around 57.5 to around 58 by the end of this year, simply because the dollar will remain dominant.
All right, the further depreciation there for the Philippine peso. What about the stock market plunging with this aggressive rate hike? How significant is the impact of this rate hike on consumers and businesses as borrowing rates go up on loans?
Well, indeed. So high inflation is really going to have an impact on the consumer spending. But to be fair, the economy is not that strong such that the corporates would have a lot of pricing power to pass on the cost pressures into the consumer. But that would also mean that the margins of the corporates would have to narrow or to tighten in this environment. So it's very difficult to expect that the Philippine Stock Exchange or any other equity market would be able to flourish in this environment.
So, with margins getting squeezed on corporates and the rising cost of money, could firms, Eugenia, freeze hire on new jobs and maybe reduce headcount due to higher overheads?
Well, that is quite likely. And actually, whenever you tighten the interest rates, that is tantamount to demand destruction. But, in this environment, when you have very high inflation, while it is not ideal to raise interest rates when the economy is not that strong, but it would be even worse if the central bank were to delay raising the policy rate and then wait until the growth is already declining and still have very elevated price levels.
Well, it will really be indeed a challenge for this new administration and for the central bank to balance growth amid major challenges in the peso and interest rate environment. Thank you so much for joining us, Eugenia Victorino, Head of Asia Strategy at Swedish Bank SEB.